Hello, Mayor, council members, and community. Today we're going to talk about compliance with 3 significant financial policies for the year 2021. That includes our cash and investment management policy, our debt management policy, and our required reserves or fund balance policy. All of these policies have been reviewed and approved by prior councils. And it should be noted that I will be taking the required reserve policy back to council sometime soon to accommodate for changes in some of the state auditor's requirements. You should see those fairly soon. These policies were created by researching best practices and suggestions from the state auditor's office. And what's the purpose of these policies? Well, it's to protect the city's assets, and it's to help ensure the long-term fiscal health of the city. And these reports to you are our commitment to ensuring we meet those objectives. So it's the policy of the city to invest public funds in a manner which provides for the highest investment return with the maximum security while meeting the daily cash flow needs and conforming with all state and local laws. The primary objectives of investing are legality, right? Our investments need to be legal. 2, they need to provide for adequate liquidity to operate the city. 3, they need to be safe, and that means a certain amount of diversification in your portfolio. And 4, they need to provide a decent yield or rate of return. This particular slide shows our cash on hand and investment balances over the course of the last 6 or 7 years. The green line represents cash on hand or cash in the checking account, if you will. The yellow line represents our investment in the local government investment pool, which is a pool specifically for government agencies that's pretty conservative, but it gets a better return than just leaving your cash in the checking account. And the gray line represents our investment accounts. Those include everything from bonds and treasuries and agencies, and we use a couple of different investment management firms to help make sure that we are in compliance with our policies there. Now you can see at the end of 2021, there's quite a big jump in both the green lines, which is cash on hand, and the gray lines. That's because, number one, we received a big infusion of cash during the year. We received over $1 million in ARPA funds, and so our cash balances are a little higher than usual at the end of the year. They were high last year as well, and so one of the things I did is I moved about $3 million from our cash on hand into the investments. So there's just a little bit of history on our total cash and investments over the last few years. So now let's talk about the debt management policy. Obviously, it identifies the city's approach to managing debt. Adherence to this is essential for maintaining good credit quality and good debt position, which is something that the creditors look at as well as the auditors. We are all within our legal limits of debt levels. The city has currently $9 million in general obligation debt. That's primarily on the Civic Center building, $4.6 million in water and sewer debt, and a new requirement, not a requirement, but this is what the state auditor's office looks at when they're looking at proprietary fund debt for our water and sewer funds. It needs to be below 12% of your revenues. Water's at 7% and sewer's at 8%. That's not in our policy, but it's something I reached out to the state auditor's office for having a little bit more in my back pocket for you. This next slide shows you what we call our Schedule 9, or what the state auditors call their Schedule 9, and it is a required schedule as part of our annual reporting process with them. You can see down the far left-hand side of the schedule, the description of the debt that we have. And towards the middle, you'll see the balances at the beginning of the year. There were no additional loan proceeds received throughout the year. That's why the additions column all has basically zeros in it. And then reductions is what we've paid down in principal. And then you have your ending debt balances as of 12/31. And this is a schedule that the auditors pay close attention to, that we're making timely debt payments and our debt loads are appropriate. Towards the bottom of the schedule, you will also see a line item called compensated absences. And that dollar amount indicates at any given point in time, if all of us employees were to leave the city on a dime, that would be the total amount of our cash outs. And this is the first year in many years that those balances have actually been reduced. And you have your HR department and your payroll folks to thank for that, because we've actually offered employees the ability to cash out vacation if they're taking adequate vacation leave throughout the year. They can actually cash it out, and that helps reduce our obligation. It actually also helps reduce the obligation when they ultimately do retire or when they ultimately do resign, and then we don't have to have that big burden of that one big outgoing payment. So next we're going to talk about our fund balance policy. Well, why do we have a fund balance policy? And I think this is a perfect illustration of why we need a fund balance policy. I just used an old graph for this, but you can see towards the left side of the graph in February of 2017, we had revenues of $583,000. Then in, I think it's May of the following year, you see we have a huge spike in revenues at $1.367 million. That is a fluctuation of $800,000 in revenues coming in to the general fund. And so this graph illustrates the volatility and fluctuation and the cyclical nature of some of the revenues that we have. So this slide shows you the main components of every fund balance calculation. It has three parts, one part up top, one in the middle, and one towards the bottom. And the first calculation that we make for our fund balance is called the minimum fund balance reserves. And that provides a financial cushion for revenue fluctuations and cyclical activity in the fund. And for the general fund and street funds, the minimum requirement for that is 15% of ongoing revenues. The maximum requirement is 20% of ongoing revenues. So that's component number one. The second component we call the economic uncertainty, and that provides a financial cushion against unanticipated adverse financial or economic circumstances, just like COVID, right? And so for the general fund and streets, the minimum is 1% of ongoing revenues and the maximum is 3% of ongoing revenues. And the final piece is future liabilities reserves. And that's just for anything that might come along. We talked about compensated absences earlier on in the presentation. And if we had a whole slew of retirements and resignations, which frankly we've been seeing, we need some reserves in order to cushion that blow, if you will. Or it might be, I don't know, an insurance claim that is, or it might be a claim that's not covered by insurance and we have to do a payout. But anyway, those are the three components of your fund balance policy. And finally, these are the actual calculations that I do to make sure our general fund, streets, water, and sewer fund balances are adequate and in compliance with policy. And down the left-hand side, you will see the three components that I talked about and the calculations. And then across the top, you'll see the general fund, streets, water, and sewer. And below those, all the calculations for the amount of the reserves that we need to have in place in order to cover those things. And then towards the bottom, you'll see how we compare the actual ending fund balance to the calculated policy requirements. And as I've mentioned before, our fund balances are excellent right now due to strong revenues and relatively controlled expenses. I'm pleased with the way that we are moving into 2022 with the fiscal health of the city. I hope you enjoyed this presentation today, and as always, if you have any questions, please let me know. Have a great day.